Welcome back, best ever listeners, to the Horizon Podcast. So it has been another busy week. I'm starting to get anxious to have the holidays and a little bit of time to rest and relax. Thanksgiving was great, but I could do for a little time off. This week I was at the Globe Street Healthcare Conference, actually here in Phoenix or Scottsdale. Fantastic event, busy, active, a lot of investors there. I'll share some insights from my keynote presentation at that event. We also had the Marcus and Millichap multifamily investment forecast this last week. If any of you did not catch that, it is available as a replay. Just go to the marcusmillichap.com website and you'll be able to register for that and download, or actually just watch it live online. Watch it online in the replay. The slides are available from that webcast. So fantastic clients on there, really active. One has an equity fund. One is using family office money predominantly. One is syndicating deal by deal. Really good insights from those investors, all of them active in the marketplace today. Lots of good information. So I encourage you to go catch that. That's a fantastic little webcast, and you can go in and catch that in the replay. Next week, I will be in New York for ICSC, so hopefully I will get a chance to see some of you there and see some of my very good friends who, including Greg Katz, who has been on the show a few times. And so I'm looking forward to that. And then I get a little time off. I'm going to see what I can do to polish up this webcast a little bit while I get a little reprieve from the office. So this week, I'm going to highlight a couple of things I picked up or shared at the Healthcare Commercial Real Estate Conference. I'm going to highlight some of the key things I picked up out of the multifamily investment forecast this last week. And I also picked up a little nugget of insight that I think is really, really going to have a significant impact on the commercial real estate investment market. And I'm going to share that with you as well. That's kind of something I don't normally pay attention to that showed up this week. And I ended up doing a little deep dive into it and found some interesting stuff. So for those of you who don't know me, I'm Chang. I have been active in real estate investing most of my life. And since 2007, I've run the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now I must mention, as I always do, that I am doing this podcast independently and that what I say on this show does not reflect the opinion or positions of Marcus & Millichap. Okay, so that said, let me jump in here with some information from the healthcare conference. I literally just pulled up my keynote presentation here on the other screen, and I'm going to take a look through for the kind of the best of the best here. Okay, so here's one thing. You know, I've been talking a lot about jobs and how the market has been softening. So for the healthcare conference, I broke out the healthcare employment. Now, I knew going in that healthcare was a big piece of the market, but I found this really significant trend that I thought was super important. The pace of hiring really dropped off in May. Right. And I've shared that before. We saw a big slowdown in the pace of hiring after the Liberation Day tariffs were announced. We see the number of new hires on a monthly basis way down. We see the number of terminations also way down so far. Although we are seeing a pickup in the number of layoffs in recent weeks. So definitely worth keeping an eye on that. But the thing that I noticed as I was breaking apart the data is that if you take that healthcare hiring since May, June, July, August, September, most recent data for this data set is September. In those, 5 months, healthcare job creation totals about 214,000 jobs. And then if you take everything else and lump it together and say, okay, everything not healthcare, for those same 5 months, the total is negative 21,400. So, and a big piece of that has been the government layoffs. So we should look at that. But, it's not the only sector that has been losing momentum. Professional business services, I think supplanted by AI to a degree, has also been losing momentum. And there are a few other sectors that just aren't as strong as they were. But the key thing here, if it wasn't for healthcare, we probably would be in a recession, or damn close. Now, I went out, I Googled it. Are we in a recession, or are we at risk of a recession? And basically, I saw the AI model pulled up. It said that we have like a 25% chance of a recession in the next 12 months based on everything that's out there on the internet and whatnot. And so nobody's pushing this recession idea. Everybody's pretty much saying, we're going to have slow growth. It's going to be positive. It's going to be slow and not a lot of momentum, but no recession. So that's good, I guess. But we're basically, and I've said this before, we're dancing along the edge, right? One thing goes wrong and we're going to stall out. But for commercial real estate, yeah, I think there'd be some impact, but I don't think it's severe. Really, honestly, I was looking at some of the longer term trends and performances and total returns and that type of thing. And ultimately, real estate tends to move more slowly. Yes, the global financial crisis had dipped into negative territory. Yes, it got hit by the pandemic, but it really didn't stall out for an extended period. In fact, this last cycle, since the Fed started hiking rates, has been a worse slowdown than the pandemic was, quite frankly, both in terms of the slowdown in velocity of sales and activity, as well as the performance of the assets, as well as the performance of the investors. So I think the pandemic was short enough that it really didn't take the hit. And on top of that, we had the government dumping tons of stimulus into the market, both the Fed as well as Congress, fiscal and monetary, both coming to the rescue during the pandemic. We haven't had that. This is a different situation where we've been raising rates, and that's really what slowed things down. So anyway, back to healthcare conference. Basically, it's propping up the economy at this point. Still has a labor shortage, right? So I think I've highlighted this in the past. The job openings have come down so much and the unemployment has gone up enough that the labor market is basically in balance, quote unquote. That means the number of job openings and the number of unemployed people is about at parity. But that's not so for healthcare. There's still a labor shortage there. And so that's going to take, we may not ever fill that. When you look at the job creation, they're basically saying that healthcare will drive 40% of all job creation over the next 10 years, with the creation of over 2 million healthcare related jobs. One of the challenges, and I brought this up in the past with other property types, is that immigration reform and the new immigration policies is definitely going to take a bite out of the healthcare market in two ways. First of all, 25%, or actually 24% of the population that works in healthcare services, 24% is foreign-born, right? Non-native Americans, people who moved here, relocated to the United States. In addition, about 5% of the H-1B visas that are by healthcare or for healthcare jobs. And a lot of those were nurses. And because the H-1B cost has been increased from a couple $1,000s to $100,000, a lot of those healthcare visas, H-1B healthcare visas, are not going to be capitalized upon. I've heard several interviews where they've been saying that basically it's too expensive, the ROI is not there anymore, and as a result, they're not going to use H-1B visas to bring in healthcare workers, which means we end up in a healthcare shortage for labor, and that drives up wage pressure. Anyway, there's a lot of economic stuff, and I guess that's what I do. What I want to highlight is, actually, before I highlight the key commercial real estate trends, let me point out one other thing. The population of people 65 and older is growing very rapidly. Over the next 10 years, we're expecting 24% population growth of people 65 and older. This is the baby boom generation. That's going to increase the number of people who are 65 or older in the United States by about 14 million people over the next 10 years. Now, this is important for healthcare because people who are 65 and older go to the doctor a lot more than anybody else. So if people who are under 18 maybe go to the doctor 1.5 times a year. 18 to 44, they go 1.9 times a year. And this is based on a study, Department of Health and Human Services. And so people between 45 and 64 go to the doctor 3.7 times a year. And that jumps to 7.1 times per year for people who are over 65. And you have that population cohort increasing by 14 million over the next 10 years, which means we're going to have about 80 million more doctor visits 10 years from now. That's 80 million more than we're having today. So that's a big number. Meanwhile, we're having labor shortages in healthcare. We can't get enough doctors. We can't get enough nurses, and so on. So yes, AI will absorb a piece of this. I don't know how much. I'm not an expert on that. But it basically tells me that we're going to have shortages of labor services availability in the United States. At some point, this is going to exacerbate. And as a result, this is why medical office is one of the asset types that I think will outperform over the next 10 years. You just have way too much demand, not enough supply of services. Therefore, we're going to have, we're going to have to expand the amount of space for medical office. They're not building hardly any of it. And the vacancy rates have been very stable. It's about 9%. Remember, this is a little different from, say, apartments or, most other property types. 9% is pretty good because a lot of this is purpose built. There's expensive build outs that go with a lot of these. So you have 9% vacancy and about 2.5% rent growth for medical office space. And that is pretty durable. These are usually tied to long-term leases, 10, 12, 15-year leases. The going concern these days is getting active lease bumps, annual lease bumps of about 3%. That's the target that I'm hearing in the marketplace. So you have some inflation resistance. You have some recession resistance, actually a lot of recession resistance. So if we do go sideways in the economy, medical office is going to be one of the best places to be. Construction's down. The number of starts for medical office is down about 78% compared to the peak of the market, which was actually in 2019, not 21 or 22 like most other property types. And the amount of space that is under construction is down by 42% compared to 2022. So basically, we're not building enough. The aging of the population is going to drive demand. You get into long-term leases with healthcare providers, especially if you do it with a firm that has, MRI imaging or something like that, where it's very, very heavy and very, very difficult to move that equipment. You're going to be in good shape. It's a long-term coupon clipper, low management, relatively straightforward investment. And we're going to have more demand than we have supply. It's a good recipe. Let me flip through, see if there's anything else that I thought was really salient. A lot of the population growth in the 65 plus is going to be across the Sun Belt, but it's also where we develop the most. Just scanning through the maps, Phoenix and Houston have the most vacancy, north of 15%. You look down into Florida, you're looking at 6% to 10% vacancy. Charlotte 5.5%. Seattle 4.8%. Basically, a lot of variance, but it's the usual suspects, right? The markets that would overbuild are overbuilding. So cap rates on medical office running average 7.5%, give or take. High range, multi-tenants, small multi-tenant, high range. So this is going to be in a smaller metro, outlying area. You're going to see cap rates as high as the upper 8% range. For best in class, single tenant, infill, location, you may be looking at a cap rate in the high 5% range. Which is great because that still should be near positive leverage. And if you have guaranteed rent bumps in there, this can make a lot of sense, especially if you're in a 1031 exchange. Okay, so that's what I got for the healthcare conference. I'm running longer than I thought I would, so I spent a little bit more time on that than I thought. So I'm going to thin up my time on multifamily investment outlook. One reason is because I did just shoot a video for this. It's posted on my LinkedIn, John T. Chang. You can look me up, follow me, and I have a video coming out. Let's see here, Monday, December. Why does nothing ever work the way you want it to? December 8th, there will be a video released focusing on the multifamily outlook. But there were a couple key points that came up in that conversation during that webcast. Again, you can go watch the replay. I think it is worthwhile. I really like the panelists who participated. We had Rob Bolhofer with 29th Street Capital. We had Rishi Gupta with Eagle Rock Advisors, and we had Carrie Wilfong with Apartment Ventures. And all of them very active, very smart investors that are out there. Housing affordability continues to be a problem. Aging millennial generation pushing back first-time home buying is driving a lot of retention, and that's a key ingredient for the rent growth. That's one thing. The other thing is that the slowdown in the employment is going to create choppy demand drivers. We're going to see a slowdown in apartment absorption. The good news is that construction is also slowing down, and it's going to vary by market. Okay, so I think the Sun Belt is going to have another year of headwinds because you still have an overhang of supply. And if absorption slows down, then you have a higher vacancy rate. It's just going to be that simple. And whereas, say, the upper Midwest, the Rust Belt, some of the other markets, California, some of the other areas, we did not get that huge wave of development, are positioned to perform a little bit better. Their vacancy rates will be holding in the mid 3%, upper 3% range at most of those metros. Whereas, the Texas markets are holding in the, low to mid 6% range. Florida markets, 5 to 7% range. So the markets where you had so many completions, you're giving out a lot of concessions. And as a result, you're really facing some real competition for tenants. Your A properties are cannibalizing your B properties by offering a lot of concessions. Your B properties offer some concessions. You pull up the C property. And in those high development markets, your Class C properties face the most headwinds because they're basically getting cannibalized by everybody. And so those Class C apartments have the biggest vacancy challenges, the slowest rent growth, and in some cases going negative. So that's what's going on there. What else I think? I'm going to bring that up next. All right. So that's what we got. Oh, cap rates, multifamily cap rates range all over the country. The average cap rate for multifamily is about 6%. That seems a little off to me, but when you bake in a lot of the stuff in outlying areas and non-core markets, it makes more sense. The cap rate range runs from the mid upper 4% up into the mid 7% range. That's what you're looking at for cap rates. So again, positive leverage is viable, but not guaranteed, right? So that's kind of the nutshell on the multifamily webcast. And I didn't do it justice. I just hit a couple of key points. Basically, a little bit choppy going forward. I still think the long-term drivers for multifamily are still really strong. I think that the momentum's there. I think that we still have a housing shortage. Even with all of the apartment buildings, apartment units we built, 1.4 million new apartments built over the last 3 years. That's, a record, at least since the 80s. So we still have a structural housing shortage. We still have, even with a slowdown in the employment market and a lot of the young people not being able to get jobs, the unemployment rate of young adults is elevated. I think it's 7.3% for 20 to 28-year-olds. That's the unemployment rate. And it's been climbing over the course of the last several months. So that's going to slow down the household formation, which means that these young people are not moving out, getting a new apartment. And that is going to be a deferral. Eventually, that person's moving out. Okay, they're eventually going to move out on their own. They're just not going to do it right now. So that's pent up demand that will materialize, 6 months down the road, a year down the road, 2 years down the road. And the key ingredient there is the clarity on policy and what's going on out there. There are just too many unknowns and it's too difficult to plan ahead. So caution reigns for a lot of people. And that's going to just slow down apartment demand going forward. I think it also influences what happens with retail and industrial, a little bit less influence on what happens with office. So there you have it. Those are the key findings from the multifamily outlook that I want to talk about here. Again, go watch the replay or go watch my video on LinkedIn where you can get more information and visualization, right? Most of you are seeing this on, catching this podcast on audio only. So you're not seeing all the graphs and graphics that go with it. And so if you watch those videos, the one on LinkedIn is 5 minutes. So give or take. So that's not bad. An hour for the online webcast. So that nugget I promised you. All right. So I got 5 minutes left. So the bottom line is that investors should expect more competition for assets in 2026. The bid pool on these properties is going to increase. And the reason is that the institutions are more likely to be active in 2026 than we've seen in the last couple of years. That means that whereas they may have been net sellers over the last couple of years, now they're net buyers, and they have a lot of dry powder. If you look at the capital raise over the course of 2025, the average quarterly capital raised for commercial real estate, it's averaging $29 billion per quarter. Okay. Now, is that good? Is that bad? Well, let me put it this way. It's well above, I think 40% above, no, not 40%, but it's well above the capital raised in 2024, which was 21 million per month, per quarter, or 21 billion. I apologize. $21 billion per quarter. I did that on the webcast today. I kept saying million until Rishi called me out and says, no, it's billions. I was like, oh yeah. Anyway, the long-term average, 2015 to 2020, the capital raise was averaging $23 billion per quarter. So we're above our long-term average. We are above where we were last year. So we're raising more capital at institutions that is targeting commercial real estate. That suggests we're going to see more activity and more bid on these properties. So that's the little golden nugget, but I got to reinforce it with a couple other things. When you look at the NCREIF Total Return Index, right? Basically, they bake in an estimate on the value of the property plus the rent growth and operating income growth. The NCREIF Annual Total Return Index is positive for commercial real estate. It turned positive in it nudged into positive territory in 2023, I think. And it has been improving over the years. So the total return index for 2023, actually 2023 was negative 6.2%. Positive in 2024, 1.4% for all commercial real estate, or the main properties of real estate, four main. And this year, 2025, it's been up at about 3.7%. So we took a big hit on our returns in 2023. That was a byproduct of the very aggressive pricing in 21 and 22, as interest rates were low. And as interest rates have risen, there's been additional pressure, also expense pressure with insurance and other things. But basically, total returns on commercial real estate were negative in 2023, turned positive in 24, and are building momentum in 25. Now, most private and investors, syndicators, equity funds, they're not really monitoring the NCREIF Total Return Index, but the REITs are, the institutions are, and they're really using that number aggressively as their benchmark for the performance. And when you look at the year-over-year gains in the S&P 500, the stock market, they're starting to lose momentum, and commercial real estate is gaining momentum. So I think some of the institutions are looking at changing horses here. moving into more money into commercial real estate. On top of that, there's been such a strong run on the stock market this year that it's going to force a lot of institutions to recalibrate their portfolios. They're going to have to pull money out of the stocks and put it into real estate to meet their allocation targets. So that's another force that's going to be out there. When you look at the total return index numbers, office was negative in 22, 23, 24, just shifted into positive territory this year. Apartments down in 23, up in 24 and 25, and building momentum. Retail, same story. Actually, retail on a total return model is generating the highest returns, about 5.1% on a year-over-year basis through the third quarter of 2025. Behind retail is apartments at 4.2% total return, 3.4% for industrial, office positive 2.6%. So up and down the line, moved into positive territory. The institutions like that. They're reallocating. They're repositioning. Let me see if I have it here. New York State Common Retirement Fund increasing their allocations, their target allocations for commercial real estate from 9% of their portfolio to 12%. So that's just one example. There's a range. Not everybody's increasing their allocations, but the thing is that the momentum appears to be shifting. There's more capital being raised. The returns are shifted into positive territory. The institutions are going to have to reallocate their funds and reposition. And I think that combination is going to increase the flow of capital into the sector. It's going to increase the bid pool. It's going to create more competition for assets. And eventually, probably not in 26, but eventually it will start to put downward pressure on cap rates if the flow of capital is sufficient. So there you go. That's what I got with my little special golden nugget of information. Basically, the market's going to get it. It's going to start heating up in 26, assuming we don't hit an iceberg, right? Assuming we don't have a major setback, something that geopolitical or policy oriented that just isn't planned for very well, maybe a gray swan or a black swan event that could cause that headwind. So we have something like that, all bets are off, right? So let's see here, Horizon. Yeah, I talked about a lot of this already, just wove it in. There is a bumpy road ahead in 2026. The slowdown in hiring is going to be a challenge. We'll probably still see some tariff risk. The Fed is likely to reduce rates December 10th, as well as in January. The outlook from FedWatch suggests rates will be dropped by 25 basis points in December, plus another 50 to 100 basis points in 2026. So rates could come down. But remember this, the 10-year treasury does not always behave itself. It doesn't tag along with the overnight rate on a steady basis. So that could actually move up depending on what happens with inflation. We're seeing a slowdown in household formation as a byproduct of the slower employment market. That means slowing consumption in retail and industrial at some point, slowing apartment absorption at some point, perhaps a little bit more churn of units. People who took 3 months of free rent to move into a Class A, they move into a Class B, and the Class B moves into a Class C. So we have that markdown on those tenants that moved upscale over the course of the last year or two, probably starting to downscale again at some point. So, what are we waiting for? Policy clarity. that is the silver bullet, right? That's the nugget. That's the thing that could drive the whole thing forward, is if we have increased clarity on federal policies and we don't have another, a major self-inflicted wound. Those are the key ingredients. So I'm going to wrap it up there, guys. Don't forget, register for Best Ever Conference. I say this every time, but genuinely, it is one of my favorite events of the year. I travel around the country. I speak at, 20, 30 different conferences, and the Best Ever Conference is probably my favorite by quite a long shot. It's just a lot of fun. The energy is great. The people are interesting, and I love the conversations that I have. It's just a hell of a community. So if you want to catch that, that is, I think, February 18th up in Salt Lake City. Register on besteverconference.com. And use the discount code podcast10, get 10% off of the rate there. So that's what I got. I'm cautiously optimistic about what's ahead. I'm hoping we don't run off the rails. I'm hoping we don't have a policy that blows ourselves up somehow on accident. If we can dodge those bullets, I think that the commercial real estate market will build momentum in 2026. It's not going to break away. I don't think so. The job slowdown is going to weigh on it too much, but we will see some positive momentum there. So that's what I got. Thank you for joining me. I will be back next Sunday and every Sunday with Real Estate Insights to help you understand what's really going on in commercial real estate. So I'll see you next week. And as always, keep your eyes on the horizon.